Hello and welcome to Money, 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 your weekly personal finance date with me, Surabhi Upadhyay. The world of debt funds can be fairly confusing, especially in today's environment where bond yields have been spiraling higher and higher. Many debt funds, in fact, are staring at losses if you're looking at returns over the last 3 to 6 months. So, what is the best approach to fixed income now? And which funds are likely to be a safe and efficient bet for the coming year? Well, that's exactly what we will be focusing on the show today. Joining me is personal finance expert Hemant Rustagi, and in some time we'll also get you a view from CRISIL. The rating agency has come out with a whole series of new debt indices to help you compare and map the performance of your debt mutual funds against these standard benchmark indices. So how to do that and how that functions, that's also coming up in just a bit. Mr. Rustagi, sir, welcome to the show. Thanks so much for joining in. So, everyone's been looking at these yields and everyone's wondering, and especially now equity getting this 10% taxation, equity markets being a little volatile. I think people are realizing that, okay, debt is obviously very important in my portfolio. Just your reading and your thoughts of what this huge rise in yields, almost 7.8, 7.9% on the benchmark. What does this mean when it comes to our debt funds?
Well, let me explain briefly. When we talk about debt fund, the general perception of investor is that I'm investing in debt fund. So it's going to be quite stable, safe, so I don't want to put money in equity, so let me go into debt fund. But the fact is, I think let's not forget the fact that when you invest in mutual fund, these are market-linked product, which clearly means that they invest in certain bonds, debentures, and whatever changes happen in their pricing, that impacts your NAV. And the third important thing to understand is there is an inverse relationship between bond yield and the returns that you get. So basically what happens in a scenario like we mentioned, the yields have moved up. Basically we were at 6.40 in January 17 and we are at 7.78. So the impact of that really is clearly seen here. So the returns have gone down. So because of the inverse relationship, it really impacts the debt fund. So you need to really keep an eye on which way the dividend yields are moving.
Absolutely. So, I was just taking a look at some of the returns, some of the data that you've also been sharing. Some of the funds, particularly funds that are exposed to long-term interest rate risk, they're actually staring at losses in the last 3 months, 6 months, thereabouts. So which are the funds which have been most vulnerable and are now seeing these negative returns?
See, the basic differentiation when we talk about different types of debt fund is the maturity duration of their portfolio. That's a basic difference. All of them invest in money market instrument, debt instruments. So there, everything is same. The difference is maturity duration. Now, if we talk about inverse relationship, now for example, if you look at gilt fund, theoretically gilt funds are those invest in government securities. They're supposed to be the safest.
The safest of them all.
But because they invest in long duration securities, they are the worst hit whenever the yields move up. So I'll give an example. In January 17, I think the 1 year return was around 15 to 20% of these gilt funds. Today, when I look at 1 year return, it's negative to 4%. So you can see the difference from 640 when the yields have moved to 7.78. And because these securities are 10, 15, 20 years, that's the impact you see. Then you have these duration fund which invest for longer duration. So any fund which is investing in longer duration, there if I see the return was around 12 to 18% is come to 2 to 6%. So clearly shorter the duration, lesser the impact, longer the duration, the more impact. So clearly investors need to be very careful when they choose their fund as to which fund are they investing. So don't look at every fund as a pure debt fund and saying, okay, I don't want volatility, so I'm investing in debt fund and I'm going to be safe.
So as I look at some of the performance rates, it's of course gilt funds, as you mentioned, duration funds, even these dynamic bond funds that are supposed to move across time periods, they have paper across ranging different maturities. There are losses pretty much everywhere, 3 months, 6 months. At times, even the 1 year return is coming down to very, very small single digits. Let's understand a more fundamental concept of duration. If you could just break this down, because the two concepts that we speak of, there's accrual, and these days I keep hearing that, accrual funds are a much safer bet. So the difference between accrual as a category and duration funds.
See, if you talk about a duration fund, what this fund, the strategy of this fund is to take advantage of the interest rate movement. So whenever the fund manager feels that interest rates are going to go down, he will increase the duration of the fund. When you talk about accrual fund are those basically which invest in 2 to 3 year securities. They're a short duration portfolio, and they try to lock investment at a certain yield. So the risk of volatility is much lesser in accrual fund. That's why, Today, it's felt that the better option for you is to look at funds which are following accrual strategy or even the short-term bond fund, because these funds are not investing for 5 to 6 years. They have maturity duration of 2 to 3 years.
Absolutely.
And as I mentioned earlier, because of inverse relationship, every fund gets impacted. But if your duration is shorter, the impact is not seen that much.
Absolutely. In fact, we will come back to this, the right funds for 2018 in just a minute. But before that, it's important to get our facts and our theory right. So 16 different categories of debt funds. That's how life will look like, because that's the new SEBI classification that has come out. So, I want to actually go through these 16 categories just to place it on record so our viewers understand what we're talking about. To start off with, the first one is overnight fund. Very simple to understand. Here, these funds are investing in securities where there's only a one-day maturity. Then comes in the concept of liquid funds. So explain this to us, because liquid funds are, very easily sort of advised upon, and we keep hearing that's a good way to park your excess cash rather than keeping it in your savings bank account.
Yeah, they are basically an alternate to your savings bank account. In a liquid fund, what SEBI has said is the fund manager cannot have a portfolio where the duration is longer than 91 days. So the maturity duration has to be up to 91 days. The attempt here is to ensure, because you're parking fund for a very short period, there should not be any volatility. Of course, there are market links. There can be some amount of volatility, but it's going to be the least in this. So a liquid fund basically is going to have maturity up to 91 days.
Okay. Let's move to category 3, ultra short-term duration fund. This is simple to understand. Basically, the underlying securities, the duration is going to be between 3 to 6 months. Then there is the low duration fund, where the portfolio duration has to be 6 to 12 months. Now we come to the 5th category, which is the short duration fund. Portfolio, I think, is between 1 to 3 years, medium duration. And as you're pointing out, as we keep going, up the duration curve, the time period is increasing. So medium duration funds, it's 3 to 4 years. Medium to long duration funds, it's 4 to 7 years. And long duration funds, wow, look at this. This category, the underlying securities will have a duration of more than 7 years.
Yes.
Would anyone invest in this? Should anyone be investing in long duration funds?
Yeah, clearly. If you are one of those investors who understand the risk which are associated with this and believe that there is a scenario when the interest rates are likely to go down. Okay. So I would
sustained fall when we're looking at a down cycle in interest rates.
Yes, I would put them something like, when you invest in equity, some part of the portfolio invest in sector fund and thematic fund. So I would put it there.
Okay.
So once you build a portfolio of debt fund and you believe that yes, the interest rates can go down and you want to take advantage of that, that's where I think the duration funds will come in. I think it's very, very important to see here. Earlier, there were duration fund. Now, very difficult for investor to understand what is the duration of a fund. It could be 3 years, 4 years, 7 years. Now, SEBI has very clearly said that this is how the duration is going to be. The name will clearly spell out as to where the investments are going to be and what is going to be maturity duration. So I think the decision making will become easier. For investors, because then there are 5 or 6 more categories.
It's far more transparent.
Exactly.
Yeah. So if I move to the next category, there is the dynamic bond fund. We briefly discussed that as well, which is playing across all kinds of time frames. So you are taking a lot of interest rate risk, from short term to medium term to long term. Money market fund. This concept that SEBI has come out with, how do these funds work?
Well, these funds have been there earlier. Basically, these are the funds that invest in money market instruments which have maturity up to 1 year. These are supposed to be very, very safe fund. You won't see much volatility there. So these are the money market fund which invest only in money market.
So it's not a sort of a long-term investment idea. Let's move forward. Then you have the category of the corporate bond funds. Now, this is where we start talking about accrual, right? Because typically it's corporate bond funds where maybe they're investing in, let's say, corporate paper NCDs where maybe the yields are even better.
Yeah, there again, I think it's up to the fund manager to decide what strategy the fund manager wants to.
Okay.
What these corporate bonds, what SEBI has said very clearly is that if you name your fund as corporate bond fund, at least 80% of the investment has to be in the highest grade instrument, which is AAA. So that's the definition. So when you're investing in a corporate bond fund, you're reasonably sure of the quality of the debt instrument. In terms of philosophy, he can use accrual or whatever he wants to do. But as an investor, you know where your money is going.
Okay, fair enough. So that's corporate bond fund. Now we come to the interesting one, the credit risk fund. Now earlier, these funds were called credit opportunity funds. Now they're being called credit risk funds. Now, what's in a name, they say, but it seems a lot is changing.
It is because of the categorization. SEBI has said very clearly that you can't use these terms of credit opportunities and those kind of terms. So obviously, every fund has to realign their existing funds, so to say. So what has happened is a lot of debt opportunities fund have now been converted into credit risk fund. The profile has changed completely. Because when you talk about a debt opportunities fund, they're investing across credit rating of the bonds, AA, AAA, AA minus. Now the definition of credit risk is because it's supposed to take risk and generate alpha for you. So at least 65% of the investment has to be in instruments which are below highest rated instruments. So maybe AA minus.
Okay.
So clearly, if you were invested in a debt opportunity fund and your portfolio was, let's say, 40% AAA and 40% AA and money market instrument, suddenly the profile has changed. So clearly, you need to keep an eye on whenever your fund is changing the name and changing the investment philosophy, you need to take a decision. Are you comfortable with this kind of philosophy or not?
Okay.